Oil pushing toward $100, bond yields at new highs, and tech under pressure are forcing a rethink of cross-asset risk. You are watching vTalkInsight, Allocator's Lens Daily for July 24th, 2026, where we connect those moves across equities, rates, credit, currencies, and commodities in one coherent view. In equities, the backdrop has shifted to a more cautious tone as rising yields and geopolitics bite. Major U.S. indices, including the S&P and the Nasdaq, fell between roughly 0.6 and 0.9%, while the VIX moved back up toward the high teens, signaling a pickup in demand for downside protection. Beneath the surface, the core tension is around AI, spending, and megacap tech valuations. Hyperscalers such as Alphabet, Meta, Microsoft, and Amazon are committing well over $200 billion each to AI infrastructure over coming years, pushing several of them into negative free cash flow and forcing investors to question the timing and scale of eventual payback. Alphabet is a good illustration of that strain. Its cloud business just delivered around 80% revenue growth with margins expanding into the mid-30s and driving the company's top line. Yet the shares dropped more than 6% as the market focused on a $25 billion capex plan and negative free cash flow rather than the AI demand story. Hardware and semiconductors are seeing the other side of that same coin. Intel posted a clear beat on revenue and earnings, with data center sales up nearly 60% and a strong outlook for AI-related CPU demand. Yet other chip names like TSMC and ASML have sold off after strong results, highlighting how crowded and valuation-sensitive the AI supply chain trade has become. At the index level, this is feeding a gradual rotation. Energy equities are increasingly being used as a hedge against equity risk given rising oil prices. Financials are benefiting from robust capital markets activity and prime brokerage demand. European banks such as BNP Paribas and UniCredit are beating earnings and raising guidance, while areas like logistics, real estate, and autos, including electric vehicle suppliers, are seeing solid fundamentals. There are also clear pockets of stress. Tesla is burning cash after nearly $6 billion of quarterly capex, relying on price cuts to drive volumes and eroding margins. Luxury and consumer names such as Burberry and LVMH are under pressure in Europe, and despite some improvement in breadth, around 80% of recent equity returns are still concentrated in semiconductors and tech, leaving allocators wary of concentration risk, just as yields and energy move higher. Turning to rates, bond markets are signaling a higher-for-longer regime that is undermining traditional diversification. U.S. Treasury yields across the curve have pushed to new highs for the year, with a 30-year above 5% for nearly a month and the 2-year at its highest level since 2025, while the usual negative correlation between stocks and bonds has flipped positive. The main driver is a mix of resilient growth and an energy-driven inflation scare. U.S. jobless claims are back to late 1960s lows, oil is flirting with triple digits, and markets increasingly worry that, absent a recession, the 10-year yield could gravitate toward 5% as investors demand more compensation for inflation and heavy issuance. Policy communication is adding to volatility. The Federal Reserve is stepping away from explicit forward guidance, making each meeting more data-dependent. And while recent soft CPI and core PCE readings argue against immediate hikes, some houses still see a non-trivial risk that the Fed resumes tightening if energy spills into core inflation and wage dynamics. In Europe, the European Central Bank has kept rates on hold, but is openly acknowledging uncertainty and running detailed energy scenarios into its September meeting, even as markets price in the possibility of additional hikes. In the UK, early tax cuts and fiscal expansion talk are nudging gilt yields higher, reinforcing the sense that developed market curves are carrying both inflation and fiscal premia that make long duration a more complex risk management tool than in the past decade. Credit markets sit at the intersection of attractive carry and rising late cycle risk. Yields in many fixed income segments now sit above realized inflation, restoring purchasing power on paper. But banks are tightening standards on both corporate loans and mortgages, reflecting greater caution about borrower resilience as rates stay elevated. Large European banks show how this tension plays out. BNP Paribas and UniCredit have delivered stronger than expected profits and raised guidance. helped by active capital markets and trading. Yet BNP is also increasing generic provisions to account for geopolitical uncertainty, and there is concern that a shift toward lighter banking regulation in the U.S. could quietly increase systemic risk over time. In private credit, structural growth remains intact, with more issuers across investment grade and infrastructure, and middle market direct lending expanding beyond sponsor-backed deals, while flows in retail vehicles have stabilized. However, there is concentrated stress in software borrowers with high leverage and low coverage ratios, especially where AI disruption is a risk, and semi-liquid fund structures are reminding investors that excess return potential comes with limited liquidity when conditions turn. In foreign exchange, the dollar is back at the center of the story. Rising U.S. yields, solid growth data, and renewed geopolitical tension, particularly around the U.S. and Iran, have reinforced the dollar's safe haven role and pushed market narratives about de-dollarization into the background. The Japanese yen remains the most sensitive casualty of policy divergence. Unless the Bank of Japan delivers rate hikes well beyond what markets currently expect, or the Fed clearly pivots lower, or geopolitical risks ease markedly, the case for a much stronger yen is hard to sustain, keeping the bias toward yen weakness against the dollar. In Europe, currencies face their own set of headwinds. Higher oil and gas prices raise stagflation risks for the euro area, where the European Central Bank must balance weak growth against stubborn energy-driven inflation, and that trade-off tends to weigh on the euro. While in the UK, early fiscal easing and structural budget concerns underpin a more cautious stance on sterling, even as the Australian dollar shows some resilience but struggles to break much higher. Commodities, and energy in particular, are the main shock absorbers in this macro regime. Persistent instability in the Middle East, renewed Houthi attacks on shipping in the Red Sea, and Iranian back pressure along key maritime routes are raising the perceived risk on as much as 4 million barrels per day of Saudi exports and turning the region into an even more critical oil choke point. That instability is showing up directly in prices. Brent has climbed through the high $90 area, approaching the $100 mark after a fifth straight daily gain, while WTI trades above $90. And some banks warned that a simultaneous disruption in both the Red Sea and the Strait of Hormuz could push Brent toward 120 in more extreme scenarios. Natural gas is adding another layer of complexity, especially in Europe. Storage levels are only around 50% versus a seasonal norm closer to 70%. Prices are near multi-year highs, and restocking is slow, prompting the European Central Bank to run in-depth scenario analysis on how an energy shock could feed into inflation and growth ahead of its September meeting. From a macro perspective, the key point is that much of the current inflation impulse is supply-driven. Energy, tariffs, and AI-related chip costs have contributed meaningfully to recent price pressures, and while higher energy has not yet fully passed through to core inflation, broader categories such as airfares, software, and core goods show that supply shocks are seeping into the underlying basket, making central banks' job more complicated than in a simple demand boom. Stepping back across assets, the picture is one of an emerging higher for longer regime, where an energy shock, elevated bond yields, and a resurgent dollar all interact with more fragile equity leadership and nuanced credit conditions. Equities still show underlying earnings strength and some welcome broadening beyond mega-cap tech, but extended AI valuations, heavy capex, and rising input costs make index-level risk-reward more finely balanced, while bonds now offer real income, yet fail to hedge equities as effectively as in the past. Credit markets, both public and private, continue to provide attractive carry, but tighter lending standards, concentrated stress in certain sectors, and evolving bank regulation argue for careful attention to where risk is actually sitting in the capital structure. On the macro side, the dollar, oil, and European gas are the key variables to watch into the autumn, alongside the next run of inflation and activity data that will shape how the Fed and the ECB respond to this supply-driven shock. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.